Imagine a stream of income flowing consistently into your account, without you having to lift a finger. This is the dream of many, and it's more achievable than you might think. That's the power of dividends, a way to generate passive income and achieve financial freedom. Dividends are payments made by a corporation to its shareholders, usually as a distribution of profits. When you own shares in a company, you essentially own a piece of that company, and dividends are your share of the profits. Dividend investing is a proven strategy for building wealth over the long term. By reinvesting dividends, you can take advantage of compound interest, where your earnings generate even more earnings over time. This can significantly boost your overall returns. It's about partnering with successful companies and sharing in their profits. When you invest in companies with a strong track record of paying dividends, you can benefit from their continued success and growth. This essay will guide you through the essentials of dividend investing. We'll cover the basics, such as what dividends are and how they work, as well as more advanced topics like how to evaluate dividend stocks and build a diversified portfolio. We'll explore key concepts, strategies, and tips to help you build a portfolio that generates passive income for years to come. You'll learn about the importance of dividend yield, payout ratios, and the significance of a company's dividend history. Whether you're just starting or looking to enhance your investment approach, understanding dividends can empower you on your journey to financial independence. We'll also discuss the different types of dividend stocks, such as high-yield stocks, dividend growth stocks, and dividend aristocrats. By the end of this essay, you'll have a solid understanding of how to use dividends to create a reliable stream of passive income. You'll be equipped with the knowledge to make informed investment decisions and build a portfolio that aligns with your financial goals. So let's dive in and unlock the potential of dividend investing together. Dividends are payments made by companies to their shareholders, typically in the form of cash or additional shares. When you own a dividend-paying stock, you're entitled to a share of the company's profits. These payments are usually distributed quarterly, providing a regular stream of income to investors. Companies that generate consistent profits are more likely to pay dividends. They view dividends as a way to reward shareholders for their investment and confidence in the company's future. By investing in dividend-paying stocks, you align yourself with companies that prioritize shareholder value and have a track record of consistent profitability. Dividend yield is a key metric for evaluating dividend stocks. It represents the annual dividend payment per share as a percentage of the stock's current market price. For example, a stock priced at $100 per share that pays an annual dividend of $4 has a dividend yield of 4%. A higher dividend yield generally indicates a higher income potential for investors. However, it's crucial to consider other factors, such as the company's financial health and dividend sustainability, before making any investment decisions solely based on yield. Section 4. Payout ratio, gauging sustainability. While a high dividend yield might seem enticing, it's essential to assess the sustainability of those payments. Investors often get lured by the promise of high returns, but without a thorough analysis, they might be stepping into a financial trap. The sustainability of dividends is a crucial factor that can determine the long-term viability of an investment. The payout ratio helps determine if a company can comfortably afford its dividend obligations. This ratio is a key indicator of financial health, providing insights into how much of the company's earnings are being returned to shareholders versus how much is being retained for growth and other operational needs. It's calculated by dividing the annual dividend per share by the company's earnings per share. This simple yet powerful formula can reveal a lot about a company's financial strategy and priorities. For instance, a company with a low payout ratio might be focusing on reinvesting its earnings to fuel future growth, while a company with a high payout ratio might be prioritizing immediate returns to shareholders. A payout ratio below 50% is generally considered healthy, indicating that the company retains a significant portion of its earnings for reinvestment and future growth. This balance allows the company to reward its shareholders while also ensuring that it has enough capital to seize new opportunities and weather any financial storms that might come its way. On the other hand, a high payout ratio, above 80%, might signal that the dividend is at risk of being cut, especially if the company's earnings decline. This can be a red flag for investors, indicating that the company might be overextending itself to maintain its dividend payments. In such cases, a downturn in earnings could force the company to reduce or even eliminate its dividend, leading to potential losses for investors who rely on that income. Therefore, it's crucial to look beyond the surface and understand the underlying factors that contribute to a company's payout ratio. By doing so, investors can make more informed decisions and avoid potential pitfalls. In summary, while a high dividend yield can be attractive, it's the sustainability of those dividends that truly matters. The payout ratio serves as a vital tool in gauging this sustainability, helping investors to discern whether a company is in a strong position to continue its dividend payments, or if it might be at risk of cutting them in the future. By paying close attention to this ratio and understanding what it signifies, investors can better navigate the complex landscape of dividend investing and make choices that align with their financial goals. Section 5. Dividend growth, the power of compounding. Dividend growth is a powerful force in long-term investing. It is one of the most effective ways to build wealth over time. By reinvesting dividends, investors can take advantage of the compounding effect, where the returns on investments generate their own returns. This creates a snowball effect, leading to exponential growth in the value of the investment portfolio. Companies that consistently increase their dividends over time can generate substantial wealth for their shareholders through the magic of compounding. When a company raises its dividend, it not only rewards its current shareholders, but also attracts new investors looking for reliable income streams. This increased demand for the company's stock can drive up its price, further benefiting shareholders. As dividends rise, investors receive larger payments, which can be reinvested to purchase more shares and further accelerate growth. Reinvesting dividends allows investors to buy additional shares without having to invest new money, effectively compounding their returns. Over time, this can lead to significant growth in the value of the investment portfolio. When evaluating dividend stocks, look for companies with a history of dividend growth. A strong track record of increasing dividends is a good indicator of a company's financial health and its commitment to returning value to shareholders. Companies that can consistently grow their dividends are often well managed and have stable, growing earnings. Aim for companies that have increased their dividends for at least 5 to 10 consecutive years. This track record demonstrates a commitment to shareholder value and suggests a higher likelihood of continued dividend growth in the future. Companies with a long history of dividend growth are often leaders in their industries and have a competitive advantage that allows them to generate consistent profits. This track record demonstrates a commitment to shareholder value and suggests a higher likelihood of continued dividend growth in the future. Additionally, companies that prioritize dividend growth often have strong corporate governance practices and a clear strategy for long-term growth. By focusing on dividend growth, investors can build a portfolio of high-quality stocks that provide both income and capital appreciation. Let's talk about some example companies that have high dividend returns. Companies like Atan DT, ExxonMobil, and Johnson & Johnson are known for their consistent and high dividend payouts. These companies have a long history of rewarding their shareholders with substantial dividends, making them attractive options for dividend investors. Starting early is crucial because the longer your money is invested, the more time it has to grow. Even small amounts invested regularly can grow into substantial sums over time, thanks to the power of compounding. For young investors, this means that starting to invest in dividend-paying stocks early in their careers can lead to significant wealth accumulation by the time they reach retirement. In conclusion, dividend growth and the power of compounding are essential concepts for long-term investors. By focusing on companies with a strong track record of dividend growth and reinvesting those dividends, investors can build a robust portfolio that generates both income and capital appreciation. The key is to remain patient, disciplined, and committed to your investment strategy, allowing the power of compounding to work its magic over time.